Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report so exciting it makes filing your taxes look like a party. Alright, maybe not, but it's a necessary part to see the health of a company. In this report we will go through Guggenheim Credit Income Fund. It's about a company's plan to dissolve, meaning they're shutting down the business, and that always has a story. Stick around because we're going to break down what's happening, what the numbers look like, and what it means for everyone involved. And before we dive in, if you're into getting the real story behind corporate filings, make sure you are subscribed. We also have a Discord community linked in the description below. Be sure to join. First things first, a quick heads up. This report, like many others, contains what they call forward-looking statements. Basically, the company makes some claims about the future. It's important to remember that things can change, new risks can appear, and don't rely too much on these claims. In this case, those claims are mostly about what will happen with the shutdown of the fund. Keep that in mind as we go through it. Now, let's get into the basics. This is a quarterly report, also known as a Form 10Q, for the period that ended in March of 2025. The company is called Guggenheim Credit Income Fund, and the commission file number is 814 Guggenheim Credit Income Fund, and the commission file number is 8141101117. This filing confirms that they did indeed file all reports in the last 12 months or for such shorter period. As you can probably expect, like any good filing, there's a roadmap of the entire document for us. It allows us to jump into any specific section really quick. It will be really useful for us if we want to jump into any important sections. Alright, let's check how this company has been doing financially. Let's scroll to the consolidated statements of assets and liabilities at E1 2001-2025. And December 31, 2024, total assets have decreased from 8.1 million to 7.2 million, but net assets decreased even more from 7.5 million to 6.3 million. So a lot less assets, less net assets, which is not great. And the net asset value per share goes from 29 cents to 24 cents. All in all, not what you want to see as an investor. Next, let's analyze consolidated statements of operations. Looking at the 3 months ended March, we see a pretty drastic change when we go from 2024 to 2025. IRO's total investment income drops from almost 700,000 to just 52,000, while total expenses increases by almost 400,000. Net investment income is now a loss of over 800,000 to end is a loss of over 800,000, and the bottom line, net increase or decrease in net assets went from a 48,000 gain to a 1.3 million loss in income, is now a loss of over 800,000 in the bottom line. Net increase or decrease in net assets went from a 48,000 gain to a 1.3 million loss in a year. Very steep decline in performance, also a really bad trend from an investor standpoint. Moving on, let's see what's going on at the consolidated statements of cash flows, cash and cash equivalents. Decreased by about $400,000, while cash from operating activities saw a very significant $8 million decrease to negative $367,000. We can start to clearly see what is happening here. The fund is losing cash and fast. It has become a value-losing machine. Next up, we'll scroll to the consolidated schedule of investments. This schedule provides detail on the companies they're invested in and how those are performing. And looking at their biggest investments, we see a lot of senior secured loans with interest rates between 8% and 13%, and some of the companies listed here are Drew Marine Group, Permian Production Partners, and Polyvision Corp. It seems they try to spread out their risk across different businesses. As somewhat stands out is what we've seen in the tables before. Most of the biggest parts of the portfolio are valued below amortized cost. To put it simple, the assets aren't worth the price of jog. Let's scroll to commitments and contingencies to find more info about the operations. Or one thing to point out is that the investment is either a delayed draw loan or a revolving credit facility, meaning some of the money they're supposed to invest or lend hasn't been sent out yet. Scroll Principal Business Capital Organization scroll. So what's this company even about? Well, let's scroll to the Principal Business and Organization section. The main goal of Guggenheim Credit Income Fund is to give shareholders current income, preserve their capital, and try to get some long-term capital appreciation. They invest in privately negotiated loans to middle market US companies. In April 2015, they decided to be regulated as a business development company. Now, because the fund hasn't been able to perform as expected, there will be a special meeting in May where shareholders will need to consider the withdrawal by the company, as well as vote on a sale of illiquid assets. Let's scroll now to management's discussion and analysis of financial condition and results of operations to get more information on their operations and overall decision process. A key point here is the emphasis on risk-adjusted returns through rigorous due diligence and active portfolio management. They target mid-sized companies with EBITDA between $25 million and $100 million and annual revenues of $50 million to $1 billion. Looking at the investment objectives and investment strategy, the fund's initial goal was growth, but that is clearly no longer the case. There is discussion of different types of loans, equity investments, and what characteristics they look for in a company, so it gives us a great overview of the portfolio. They're also trying to keep things relatively safe by investing in more senior parts of a company's structure, which gives them repayment priority. We can also see that they're investing in these covenant-lie loans, which are loans that don't have a lot of the usual protections for the lender. Now let's jump over and review the consolidated statements of cash flows and examine their total numbers. Their average net asset numbers are 6.8 million for 2025 as compared to 28 million, which is drastic. Their total operating expenses increased sharply, and they have net investment losses as opposed to net investment income from last year. What all this points to is a pretty sharp reversal of the economic condition for the fund. Looking at total operational liquidity, we're talking about cash and other short-term assets minus short-term liabilities. Here we see the number almost cut in half, going from $2 million to around $1.2 million. This isn't great because a reduction in overall liquidity suggests less financial flexibility. One really important piece is to read the risk factors, since the risks will tell us what the company's management think are serious threats. These will tell us that are concerned about factors that could seriously affect the fund. In the risk factors section, they mention about the liquidation and that the company will be sold. These points shows investors that there are big changes incoming. And finally, let's check the components of net assets. As of the report, there's a accumulated loss of 22, an accumulated loss of 20 million, to the loss of 20 million, to loss of 20 million, to the loss of 20 million, to the loss of $20 million. And of course, at the end, we see the signatures of the Chief Executive Officer and Chief Financial Officer, because they are the ones that are attesting the truthfulness of this report. All in all, it paints a clear picture. This fund has seen better days, and the people in charge recognize the need to pull the plug. Now, putting aside the numbers for a minute, let's discuss my take on what is happening here. Guggenheim Credit Income Fund is navigating a really tough situation. Shutting down is never easy, and what is clear from this report is that the numbers are not looking up. The company has been accumulating losses. There has been a very significant reduction in operational liquidity, with cash numbers almost being cut in half. This will definitely lead to more stress for their investors. It may also show how quickly a business can change course, especially in a tough market. But it's not all bad news. Management appears to be proactively addressing these issues with their liquidation plan, even with the inherent legal disclosures and all the talk around potential risks. That's good leadership. Ultimately, Guggenheim's decision to dissolve reflects a realistic assessment of their current situation and strategic challenges they face. It will be interesting to see what happens with similar companies and other investment portfolios and funds in the future in light of what is happening with this situation. What do you think? How would this affect you as an investor? Let me know in the comments below. But if you found this breakdown useful, please make sure you hit that like button and subscribe for more videos. If you really love this stuff, make sure you join our Discord community. It's linked in the description below. Thanks for watching, and I'll see you in the next one.